Imagine waking up tomorrow. You check your bank account before school or work like usual, except instead of seeing maybe a few $100 or a few thousand if you're lucky, you see $1 billion. $1 billion. And the craziest part? You didn't invent a company. You didn't sell a product. You didn't even work a normal job. You made that money in one single day, simply by betting that a country's currency would collapse. Sounds impossible, right? But in 1992, that is exactly what happened when one investor made the most famous trade in financial history and earned $1 billion in a single day. And here's the crazy part. The country he bet against was the United Kingdom, and the investor? George Soros. This event would later become known as Black Wednesday, 1992 currency crisis, the day the British government lost billions trying to defend their currency. But here's what most people don't realize. This wasn't just a lucky gamble. There was a very specific financial weakness that almost nobody noticed. And once Soros understood the math and psychology behind it, he essentially found a $1 billion opportunity hiding in plain sight. My name is Steve, and I spend way too much time thinking about how money actually moves through the global financial system. If you're someone who has ever wondered why some investors seem to make unbelievable amounts of money, or why financial crises keep happening over and over again, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Because today we're breaking down one of the most insane trades in financial history. Not just what happened, but how someone can make $1 billion in one day. And more importantly, what this teaches us about how money really works. The problem with how most people think about investing. Look, most people think investing works like this. You buy a stock, you wait a long time, hopefully it goes up, maybe you make 7 to 10% per year if you're doing well. And that's actually good advice for most people. But here's the thing. The biggest fortunes in finance are rarely made that way. They're made when someone notices a broken system. Something that shouldn't be happening economically. Something that mathematically cannot continue forever. And then they place a very large bet that reality will eventually catch up. That's exactly what happened in 1992. The British pound problem. To understand this story, we need to go back to the early 1990s. At the time, the United Kingdom was part of something called the European Exchange Rate Mechanism, also known as the ERM. Now, that sounds complicated, but the idea was actually simple. European countries wanted their currencies to stay stable relative to each other, so they made an agreement. Each country promised to keep their currency within a certain price range compared to others. For example, the British pound had to stay within a specific range compared to the Deutschmark, which was Germany's currency at the time. If the pound started falling too much, the Bank of England would step in and buy pounds to keep the price stable. Think of it like a government propping up the price of its own currency. And on paper, that sounded like a great idea. But there was one huge problem: the economic reality. In the early 1990s, the British economy was struggling. Unemployment was rising. The housing market was falling. Businesses were slowing down. Normally, when an economy is weak, a country lowers interest rates to encourage borrowing and spending. But the UK couldn't do that, because if they lowered rates, their currency would fall below the ERM limit. So instead, they did the opposite. They kept interest rates very high, which made the recession even worse. And this is where George Soros started paying attention. Here's what most people didn't realize. Look, currencies are ultimately controlled by supply and demand. If investors believe a currency is too expensive, they start selling it. And if enough people sell, the price eventually falls. Now, the British government believed they could stop this by using their foreign reserves, but Soros noticed something important. The entire British central bank only had about $44 billion in reserves, but global currency markets trade hundreds of billions of dollars every day. So, mathematically, The government was trying to hold back an ocean with a bucket, and Soros realized something. If enough investors bet against the pound, the government literally wouldn't have enough money to defend it. The trade. Now this is where things get really interesting. Instead of buying pounds, Soros did the opposite. He borrowed billions of pounds and immediately sold them. This is called short selling. Here's a simple example. Let's say the pound is worth $2. You borrow 1 million pounds and sell them immediately. You now have $2 million. If the pound later falls to $1.50, you can buy those pounds back for $1.5 million, return them to the lender, and keep the $500,000 profit. Now imagine doing that, not with £1 million, but with $10 billion worth of currency. That's exactly what Soros did through his hedge fund, Quantum Fund. The psychological battle. Now you might be thinking, why didn't the government just stop him? Because financial markets aren't just about math, they're about psychology. Currencies only work if people believe they will hold value. The moment investors start thinking a currency might fall, everyone rushes to sell. And that's exactly what started happening. Other hedge funds noticed Soros's decision. Banks started betting against the pound too. Suddenly, billions of pounds were being sold. Every hour, every minute, the pressure kept building. The government fights back. On September 16, 1992, the crisis reached its peak. This is the day now known as Black Wednesday. The Bank of England started buying massive amounts of pounds to stop the fall. They spent $15 billion in a single day trying to defend the currency. Then they made another desperate move. They raised interest rates from 10% to 12%, then announced they might raise them to 15%, which is an insanely high rate. Imagine if mortgage rates suddenly jumped to 15%. The economy would collapse. But even that didn't work. Because the market knew something the government didn't want to admit. The pound was still overvalued. The collapse. Eventually, the government ran out of options. That evening, the UK announced they were leaving the ERM system, and the pound immediately collapsed. It dropped about 15% against the Deutschmark and 25% against the US dollar. And this is where Soros made his $1 billion. Because remember, he had already sold $10 billion worth of pounds. When the currency fell, he bought them back much cheaper, and the difference became profit. Estimated profit? About $1 billion in a single day, which is why Soros became known as the man who broke the Bank of England. But here's the twist. Here's what most people don't realize. This trade actually helped the UK economy. Once the country left the ERM system, they were finally able to lower interest rates, which helped businesses borrow again. The economy eventually recovered. So, ironically, the investor who broke the currency may have actually accelerated the recovery. The bigger lesson. Look, most people think financial markets are random, but the biggest moves usually happen when governments try to fight economic reality. Currencies can't stay artificially high forever. Housing bubbles can't inflate forever. Stock market manias can't last forever. Eventually, the math wins, and investors who notice those imbalances early can make enormous amounts of money. The psychology behind big trades. Now, I want to talk about something deeper here, because Soros wasn't just good at math, he was good at understanding human behavior. Markets move because of belief. People believe prices will keep rising. People believe governments can control outcomes. People believe trends will last forever, until suddenly they don't. And once that belief breaks, everything moves very fast. Actionable lessons. So what can regular investors learn from this? Because, let's be honest, most of us aren't managing $10 billion hedge funds, but the principles still matter. Lesson 1, Pay attention to incentives. When governments or companies are trying very hard to maintain something, there is often a reason, and sometimes that reason is they know the system is fragile. Lesson 2. Markets eventually correct themselves. You might see bubbles in housing, crypto, stocks, whatever it is, but eventually prices reconnect with reality. Always. Lesson 3. The biggest opportunities come from unpopular ideas. When Soros made this bet, many people thought he was crazy. Betting against a government is terrifying, but sometimes the crowd is wrong. Final thought. Look, making $1 billion in a single day is obviously extremely rare, but the reason this story matters is because it reveals something important about money. Financial markets aren't just numbers on a screen. They're hidden systems full of fear, confidence, and mistakes. And when someone understands both the math and the psychology, they can see opportunities most people completely miss. That's exactly what happened in 1992. One investor looked at the system, saw a crack forming, and placed the biggest bet of his life. And in one single day, that bet turned into $1 billion. If you enjoyed this breakdown and want to see more crazy stories from financial history, make sure to subscribe because some of the biggest money events ever are also the least understood. And once you understand them, you start seeing the financial world very differently.